It's been almost 2 decades we've been on this journey to educate, liberate, and help you take action so you may better manage your financial future, achieve peace of mind, and accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you set your goals and guide you along the way to help you achieve them. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. I'm your host, Johnny Dean, with our own Rick the Professor Plum, Chief Financial Planning Officer. Podcast time. That's right. This is my favorite time of the day where I get to talk. And my other favorite time is when I get to talk with the person who is sitting here to my right, which is Chris Lloyd. Chris, one of our many Lucia Capital Group advisors. Hey, welcome, Chris.
Hey, thanks, John. Glad to be here.
Well, I'm happy to have you here. You happen to be in town for conferences and stuff like that. And so I said, I literally did this. I went into the hallway. I said, Chris, come on in. I got to get you on the podcast. So I appreciate you being here. You're also a CHFC, Chartered Financial Consultant. You got an MBA, and I'm probably a whole bunch of other stuff that I don't even know. But it's nice to have you. You work in our in the Lucia Capital Group Phoenix Scottsdale office.
That's correct,
actually. And we will get into some of the stuff that you see a lot of, and your area has a lot to do with annuities.
Right.
And annuities, we have all kinds of different opinions on that. But before we get into that, one of the reasons that people tend to buy annuity products has to do with their need for lifetime income. And you had said, or Professor Plum had told me, that you had been to, was it a conference with Wade Pfau? And people have heard Wade Pfau's name.
Yeah.
Tell us a little bit about who he is, first of all.
Yeah, so Wade's a PhD. I believe it's in mathematics, and he's the director of the Retirement Income Planning Division and Designation of the American College. Now, the American College, if you don't know that name, is where a lot of us financial advisors get our designations, like that CHFC that you mentioned. So when it comes to retirement income planning and having an academic crunching numbers, Wade Pfau is one of the best guys in the country for doing that. And Wade's got a new book out, so he's doing some seminars around the country and that kind of thing for financial advisors and others. And so that's what this was. And obviously he can't give us the whole script of the entire book in a couple-hour seminar presentation, but he hit the highlights, and so it was a good time.
So what was his main focus here? I mean, was he talking mainly about? It's hard to separate in annuities and lifetime income, but maybe the importance of lifetime income, or what was, if you had to give the gist of what he was talking about, what was it?
Yeah, so he comes at it from a mathematician kind of standpoint, and what he does is he says, all right, what's the way to generate retirement income when somebody's retired? What's the way to do it? And he looked at the different studies that have been done in the past you've heard of the 4% rule of thumb as a rule of thumb for people to use. So he's looked at that. He's talked about that. He's crunched different numbers on time segmentation approaches. He's looked at that as well. And of course, he's looked at lifetime income annuities. And bottom line conclusion is he feels like a combination of using a lifetime income annuity to pensionize or guarantee a essential amount of income that somebody's determined they need, in addition to a segmentation type of a strategy on the rest of the portfolio to generate additional income, is the way to go.
So he's sort of saying what we've been saying for these many decades.
I think so, yeah.
It's nice to get that, especially from somebody who's got the math brain. I mean, let me put it this way. In my opinion, everybody needs lifetime income.
Right.
Some people just have it because they got $40 million in the bank and they spend less than $100,000 a year. All right. But that's their lifetime income source. I believe everybody needs it in some form or another. The question is, do you purchase it, or do you figure out a way not to purchase it and try to use up your own assets?
Or do you have it from somewhere else? For example, pensions and Social Security. Those are annuities.
Absolutely.
That's lifetime income.
Absolutely.
So as let's pretend I need $60,000 a year and I've decided that's my essential income. Well, what are the first couple places I can pull that from? If I was lucky enough to have a pension, that'd be number one. Social Security might be number two. So those meet that. Then if there's still a gap and I want to cover the essential income, What do? I can then go buy an annuity. Lifetime income is for everybody. That doesn't mean that buying an annuity is for everybody.
Absolutely not. And that's what but you hit it on the head right there, because a lot of people think of annuities and annuity salespeople, and it's like they think it'll solve everything. So you have people on the other side who should never say you should never ever consider. We know that the truth is likely somewhere in the middle. Now you've had a long background, fixed annuities, index annuities, different types, and you've been doing this for at least 25 years that I know of. You have have said that annuities are for retirees, but that doesn't mean that everyone should buy an additional income annuity. It only depends on an individual situation.
Absolutely, it does. Every single person, I can tell you this as a financial advisor who meets with people all the time and has for a long time, every single person or couple that I sit across from is different. So it's only until you build out a plan and learn about somebody's situation that you can then begin to know what tools are needed, which ones aren't. An annuity is simply a tool with pros and cons like everything else.
Exactly. And I've likened all these products to tools that you can actually see.
Right.
Somebody might say, well, is a hammer any good? Well, I say, well, what's the job? If it's putting a nail in a piece of wood, yeah, it's probably the best thing you can do. If you're trying to dig a trench, it's not so good. It's not the hammer's fault that it can't dig the trench. It's just that you're using the wrong tool.
That's exactly right, John. And, a lot of times people who are in the annuity business, annuity salesmen, for the lack of a better word, right? Mm-hmm. And, hey, let's face it, I sell annuities as part of what we do. A lot of times where they go wrong is they get caught up on this type of annuity is far better than another type of annuity. And they'll hammer away, using the tool pun intended, they'll hammer away this idea that, oh, no, my annuity is the best type of annuity and somebody else's isn't. And when you listen to that should be a warning sign to you. The reality is, the way I like to handle it when I'm talking with people is, if we've determined that lifetime income is important to them, and if we've determined that buying a lifetime income annuity is part of that to fill that gap we were just talking about, then I will walk through the different choices, fixed index, variable. We'll walk through all those different options and see which one has the most appeal and interest for that particular person. That's the way I do it. And by the way, annuities get a bad rap, in part justifiably so, because salesmen exaggerate these features.
Well, exactly. It's like, if I go back to the hammer analogy, hammers might get a bad rep because they can't dig a trench. But it's not the hammer's fault. If all I sell is hammers, I'm going to try to make sure you get one for pounding nail, for digging a trench,
right,
and for painting your bedroom.
Right.
One way or another, I'm going to try to get you to do it. So it really is with the sales. How is the average person supposed to discern this, though? I mean, how do they determine if what they're being told is right?
Yeah, it's really tough, because there are some really, really good annuity salesmen out there in terms of their messaging. They make it sound really, really good. So my answer to that question is, it starts with your selection of an advisor. So some ways to protect yourself, in my opinion, is, and this is going to sound biased because I happen to be a CFP.
Please do.
There are hundreds of thousands of financial advisors out there, but only something like 75,000 CFPs out there. So one way for you to sort through all the noise out there is to find an advisor that is a CFP or is a part of an organization that has lots of CFPs in it. Not all the time, no guarantees, but that's a good way to start the process. Another thing to do is to simply ask that licensing question. Is, if somebody's pitching a variable annuity with the guaranteed income benefit to you, then ask them, are they licensed, and do they have relationships with fixed index companies as well? And vice versa. Ask them, well, are you licensed to sell variable annuities? That will help you sort through a lot of the noise as well.
That's an excellent point. I mean, variable annuities, they get a bad rap, but they're expensive. They can be. In many cases, they can the fees can really eat into it. So you have to know what it is you're buying. But let's say I have some.
Let me. Sorry to interrupt you, but let's talk about that expense piece for a second, because you're absolutely right, and that's something I explain and disclose to anybody I talk to, because I want them to know that right away. But Wade Fowle, one of the big points he made in that seminar the other day was, he said, you know what? Yes, there's extra expense there, but from his mathematical research of retirement income strategies, the income leverage, as he calls it, that you get out of having an income annuity that might pay you 5% or more versus using the rule of thumb of 4%, that income leverage that an annuity might add to the portfolio may justify that extra expense that's inside of an annuity.
It may, but the only way to find out is to maybe run the numbers and make that determination. If I had an annuity, let's just say I'm a retiree and I had an annuity that is guaranteed to pay me by the insurance company, the full faith and credit, that's who's backing it up. Right. With the insurance company.
Good point.
And if I have an annuity that's paying me, I have Social Security and I need an extra $5,000 a year or something, and it's paying me that, and it's guaranteed by the insurance company to pay me that, whether I live to be 85 or 185, I'm happy with it. What argument would somebody who says you should never own annuities have against that?
Usually the argument comes back to they de-emphasize the guaranteed income part, which is where you started that, and they overemphasize the fees and expense part. On a fixed index annuity with a guaranteed income rider, the fee might only be about 1%.
True.
Right?
Okay. Right.
Variable annuities is usually where they draw that comparison because that's what they're used to.
Which is fair. They should. You should mention that. Let's get into I'm talking to Chris Lloyd. For those who just read the cover of the podcast, you'll see who this is. Talking with Chris Lloyd, Certified Financial Planner Professional and CHFC. Talk for just a moment about, obviously some people should consider income annuities. We'll speak about those and those who should not. First of all, who would not be a good candidate? What would be a scenario for an income annuity?
Let's say a large amount of income coming from Social Securities and pensions, far in excess of what they've determined their essential expenses are. That person may look and go, why do I need to buy an annuity within my portfolio? And they'd be absolutely right in saying so because they are already bringing in, let's make up a number, $100,000 worth of income, and they live off 75. I think that's a perfect example of somebody who doesn't need to go buy a lifetime income annuity.
On the other side, let's talk about somebody who probably could use. These are hypothetical examples, but I just want to bring this up to give people an idea of what it is that you would go through when you're either making a recommendation for or against a lifetime income product.
Yeah, so if you're looking at those same type of calculations and you're saying, all right, we need $100,000 of income to cover essential expenses, and we've only got, let's say, $60,000 coming from Social Security and pension, then you got a $40,000 gap. So the question is, how are you going to fill that gap? Are you going to use a guaranteed income approach like an annuity, or are you going to use what Wade Fowle would call a probability approach, where you manage a portfolio and take a reasonable withdrawal rate of a 4% type of a distribution and go from there? So that's what you have to weigh. And I don't push one way or another. We talk through those issues and let them decide whether or not they feel like that needs to be guaranteed or not. In that scenario that I just outlined, what did I say, a $40,000 gap?
Uh-huh.
So, a $40,000 gap may require $800,000 worth of the portfolio to go into an income annuity. Well, depending on what size that portfolio is, somebody might go, ooh, I'm not going to put that much of my portfolio into income annuities, and justifiably so. And so they may dial that back and say, all right, well, I'm okay with 20 of that 40 being guaranteed, and the other 20 I'll pull from the probability approach of the portfolio.
Yeah, you never want to put 100%, but you still don't want to do something like that.
No, and that's the mistake that I see a lot of, again, going back to the annuity salesman moniker, the mistake a lot of annuity salesmen do. They see, you've got $1 million portfolio and you need $40,000 a year. Let's take $800,000 of the portfolio, 80%, and put it in lifetime income annuity. Well, that only leaves 20% wiggle room for other things that come up in life. And just like in life before retirement, stuff happens in retirement.
Absolutely. It's an excellent point. You've talked before, Chris, about this sort of growing body of academic support, about things that we talked about. You said this here earlier in the podcast, that you need to have enough guaranteed lifetime income to kind of cover your essential retirement expenses. So you have sort of your needs, things that you have to have, and then you have stuff on top of that. Talk about that for just a moment.
Yeah, so academics, for a long period of time, economists have looked at this issue of lifetime income, and they've come to the conclusion that given the longevity risk, the uncertainty of how long we're going to need to withdraw from a portfolio, that lifetime income annuities, whether it's pension, Social Security, or one that you've bought in addition to have a very high guaranteed for that portion probability of not running out of money in retirement.
Yeah, potentially.
And so economists have long been quoted as saying that that's the best answer. Guys like Wade Fowle or Moshe Milevsky, who we've talked about in the past.
Oh, yeah, we've had him on the show, sure.
Absolutely. So those guys have looked at this issue as well and all support the idea of having potentially a lifetime income annuity in the portfolio in addition to other things.
Do you get people asking you what type of income annuity is?
Yeah, all the time.
Obviously, everyone's situation is different, but that's a question that can come up.
Yeah, John, unlike some people, I'm a little bit like Wade Fowle. I'm a little nerdy when it comes to this stuff. And so some people on the radio or television or wherever really push one type of annuity. And so when somebody comes in to see me, they may have that one type in mind, and that's what they may think that they need or don't need, and they may think the others are bad. So I will stop and we'll walk through all those different options so that they have a good sense of what those things are. And another point I'll make is Part of the reason salesmen can be, when it comes to annuities, is because annuities that have historically been sold and are sold today are sold on a commission basis. That's been changing in recent years.
It sure has.
And so there are more and more, particularly variable annuities, available on a advisory or fee basis, which takes that commission incentive off the table. Now, I will still have, when somebody comes in to see me, who look at both those options and sometimes say, no, I'd rather do a commissioned version than a fee-based version, but that's an assessment the individual gets to make. So,
yeah, it is. And never, these things are never 100% bad or 100% good.
That's right.
There's always something in the middle. Again, we're talking with Chris Lloyd, and I don't want to keep you I could talk to you for an hour, and I know you got other stuff to do. But just speaking in terms of doing overall planning as a financial planner,
yep.
The first thing I would assume that you look at when somebody's putting a strategy together would be, what do you have guaranteed coming in? What is guaranteed coming in versus how much we know how much you need. Do you look at guaranteed income? Was that one of the first things that you look at?
Yeah, I call it the retirement equation. So the basic equation is, how much do you need? Now, you just made the assumption that people know the answer to that question. That's not always true. I'm oftentimes surprised that people don't have a sense of that in some cases. So we work on that if that's the case, right? How much do you need? How much are you going to have coming in from these guaranteed sources, Social Security, pensions, et cetera? What gap does that leave us? That's the basic retirement income equation. And from there, we can go, all right, what's it going to take to fill that gap? Either using an annuity or using a reasonable withdrawal rate. That's how we begin to start building out a retirement income plan.
Yeah, which, here again, we've kind of reduced planning to its most basic form, which is, how much do you need? How much have you got guaranteed? What is that gap?
That's
if
right.
There's no gap, then you don't need anything. You don't
Right.
need any.
Right.
So essentially, you have enough guaranteed income coming in between Social Security and pensions or whatever it happens to be, which is why I laugh when somebody says, guaranteed income? What in the world would you ever want that for? Don't ever consider that. Go out and invest it.
Right.
Markets do whatever it is, which to me is highly dangerous. I find it comical that anybody would ever say guaranteed income is no good, because nobody wants to take a chance that they're going to live to be 95 and they're only going to have enough money to get to 85.
Well, that longevity piece that you just mentioned, that's an interesting point all in and of itself. Studies have shown that most of us underestimate longevity. So I can ask you, how long are you going to live? Nobody knows, of course, is the answer, but most people will guesstimate an answer that's much less than what the actuarial charts tell you. So I could tell you that the actuarial charts on average say, about 85 for men, about 87 for females. That's an average, right? Which means some people live longer, some less,
sure,
et cetera. But most people would say, oh no, well, my dad lived till he was 80 and da-da-da, and they'll come up with a number that's less than that. So looking at that question of longevity and understanding that risk that you just stated so simply is a key point that most people underestimate. And it's a point where people like Dr. Wade Pfau overemphasize that point, is that is an unknown, and that's what makes retirement income planning so complicated. If it wasn't for the unknown of longevity, it'd be real easy. I could do the math on the calculator, tell you exactly how to run your portfolio.
You could do it on an abacus probably, and just, it's simple math.
I'm not as old as you, John, so I don't happen to have an abacus available. So,
tell you what, I see, personally, and I've said this over and over for years, I'm the kind of guy that at least I want to know what's the worst case scenario. What is the least that I am to get? And then I can either adjust my life if I have to, or I can make adjustments along the way and figure it out. So I'm a little bit biased on the guaranteed side, and I will admit that, but the problem is that too many people just don't understand how it works, and you live in an area and work in an area, Scottsdale, Phoenix, for whatever reason, maybe because there are a lot of retirees in that area, but there are a lot of, I don't want to use a disparaging term, but there are a lot of annuity sales people out there.
I think that's a true statement. And let me add to that if you own an annuity, now's a really good time for you to review that annuity and see if it's doing everything you want it to do for you. And I'll say that, I'll kind of give you an example. Let's say you bought a variable annuity 10 years ago. And 10 years ago, probably would have been a pretty good time to buy one, right? You're buying at the bottom of the market and starting its rise back up. Market's cooperating. If it's a variable annuity, you've had some growth in there to offset the withdrawals. So you might have been withdrawing income from that thing for 10 years, and the value's as high, if not greater, than the premium you put into it, right? So maybe at that time, when you were planning for a longer time horizon because you were 10 years younger, then that particular annuity was the answer. But now that you're theoretically have a shorter time horizon, even though it's still lifetime income, you might be able to reassess that and get a cheaper income rider. You might be able to drop, perhaps you bought an enhanced death benefit at the time. Maybe you can drop that enhanced death benefit, which is costing you extra money. So there are a variety of things to look at when you're talking about an older lifetime income, whether it's variable or fixed indexed, and whether or not that's still performing in terms of objectives for your plan.
That's an excellent point. You may have some tax considerations too, older ones. Maybe you can look into some long-term care stuff, which we've talked about before. Right. Any number of options, but that's an excellent point. My goals 10 years ago might be different from now. Maybe I got a windfall. Maybe I inherited something I didn't expect. Who knows? But it's another good reason that you need to go over everything that you have every so often. Make sure it's still in line with your goals.
That's right.
Chris Lloyd, thank you so much. I kept you a lot longer than I said I would. So
I'm going to get fun talking to you, John.
Well, I enjoyed it. And if people want to get in touch with you, if they're in the Scottsdale area or anywhere, if they have some questions, where can they call just the standard 800 number?
Absolutely. So it's 800-644-1150, extension 10 for the Arizona office.
Extension 10. There you go. Chris, thank you so much. Next time you're in town, I'm going to grab you again, so just be forewarned.
Sounds good. Thanks, John.
All right. Thanks, Chris. I'm Johnny Dean. Thanks very much for listening, folks, and we'll talk to you again real soon.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by Lucia Capital Group, will be either suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Insurance products offered through Lucia Securities, LLC, California Insurance License Number 0H40817. Lucia Securities is licensed to offer such insurance products as life, disability, long-term care, and annuities. Variable annuities are long-term investment products designed for retirement purposes. Variable annuities with guarantees are available through optional riders at additional cost. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Before investing, carefully consider a variable annuity's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Fixed indexed annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Investors should speak with a financial professional about the contract's features, benefits, risks, and fees, and whether the contract is appropriate for the investor based upon his or her financial situation and objectives. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Long-term care coverage policies and provisions may not be available in all states. Approval may be subject to the terms and conditions of the insurance company. Insurance product guarantees are subject to the claims-paying ability of the issuing insurance company and are subject to their terms and conditions. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. The investment professionals are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. Lucia Securities, LLC was acquired by LPL Financial August 2020. The investment professionals of Lucia Securities, LLC are now affiliated with LPL Financial and are conducting business using the name Lucia Capital.